former senior trial attorney from the IRS and a tax attorney for what is it going on 30 years now. So, Scott, you've been doing this a long
Oh, I don't like to admit that, but yeah, I think you're
time.
right, Don. I left the IRS end of '94. So yeah, it's coming on 30 years here that I've been fighting for the good guy, I guess. But
Okay.
it's kind of surprising, Don. I think, you and I have been working together for over 20 years now. I think that, it's 23 or something years or so. And, we really haven't focused on this particular topic of minimizing your taxes and what happens in retirement. And, this is a topic I think that is important for people not only who are currently, quote unquote retired, but are also maybe close to retiring or wish to be retired at some point, which could encompass a whole lot of us here. So, I think it's something, we probably should have done earlier, but, better late than never here. So, anyways, thank you, Don, Kendall, and Protect Wealth, and everybody for spending a few minutes tonight with me on the minimizing taxes in retirement. And I think it's a real important topic because again, we're all sort of in that mode of at some point here we're going to retire, and at some point do we want to make sure that we have enough money to retire. And when I thought of retirement, especially when I'm in law school and I'm in my 20s, is that's something that's always far away in the future. But I think for a lot of us now, and there's even this movement of people that are quite young, that they're seeing that going out and getting a job, when you're in your early 20s and working for the next 40 years, and then retiring and maybe living and retiring and having a few years to do a few things isn't really all that appealing. And maybe we want to retire a lot sooner than the quote unquote people retiring at the traditional ages of whatever, somebody in your 60, 65, or whatever the age happens to be. So I think planning retirement, and again, this is something that I talk about on a lot of different webinars, whether it's for Don or whoever, is that anybody that's in business, or if you are employed and you have the opportunity to contribute to a retirement plan, that is like one of the top couple tax strategies that pretty much anybody in America can utilize. So, in addition to, let's say, maybe the opportunity to go buy a home and exclude some capital gains if you satisfy some certain rules where the home ownership is a really nice tax strategy. So are these different contributions. And this is not just your regular IRA sort of contributions where, we're right here in the middle of the screen where we can put in somewhere between 7,000 and 8,000 a year, depending on our age. You can see the columns here just showing our limits last year and then our limits this year as well. But look at the big amounts that we can put into these 401k plans and these SEP IRA plans, which you're going to see the amounts are the same here, right? The 69,000 here and the 69 here. So when we're looking at these different plans or into some of the nonprofit type plans, when you're looking at the 403b plans here, same type plans as far as what we can contribute. Now, that doesn't mean that we need to contribute what's in this column, but it's the maximum that we can put in to one of these defined contribution plans. And there's also pension plans out there that would take way more than I could ever go through in one particular webinar. But just understand that those pension type plans, you can put potentially a lot more money in than these particular plans. Although you start looking at, let's say you're 30 years old and you start contributing this $69,000, and it goes up a little bit every year. So I would expect 2025 to be in the low 70s somewhere. But if you imagine if you were making enough money that you could contribute $69,000 a year for 10 years, contribute almost $700,000 into this retirement plan, and then just let time work its magic with investment You could retire a whole lot sooner than what you think, especially if you consider that in any of these plans, the worst case scenario is that whatever your investments are doing, so you put the 69,000 in, whatever that grows to over a period of time, maybe that grows to 690,000 because you're getting a 10 times return on your money over a huge period of time, right? 30, 40 years, or you hit it big time in an investment. Whatever it happens to be, all of that investment income has never been taxed. And that's the key part that we're going to talk about tonight is when that money comes out, is it going to be taxed? And if so, how is it going to be taxed? Or is it going to be through one of these Roth plans, okay, where we see this Roth IRA contribution where you're putting the money in after you pay tax. So you've already paid tax. It may take you 10,000 bucks to earn the 7,000 to put in, right? Whereas this one over here, this is going to be post-tax. So we have different opportunities depending on our overall financial plan. But we also have to, I think, look at this whole sort of dichotomy of how are we planning in retirement with the different options that are available. So, I don't give financial advice, and obviously, I'm not giving specific legal or tax advice tonight since I don't know anybody or your specific situation. But these are some of the general things that I think really everybody should be considering if you are either retired right now or you're getting close. And what I mean by close is I don't necessarily mean how you're going to retire, this month or sometime this summer, but if you're getting within even 5 years of retirement, where you need to start doing some planning now so that you understand that when you give up that job that you have and that W-2 income, or that you decide that you're going to sell off that business that you've had and you've been running for multiple years, and now you're going to live off of the income, from the sale of the business or whatever. What sources of income do you have, and how are these guys going to be taxed? So at some point here, you're going to be looking at Social Security. Okay. And for those that have been contributing into railroad retirement, an alternative sort of Social Security system, and one that produces better benefits, better meaning higher benefits during retirement, you're going to get some sort of benefits here at some point, and these are going to be taxed as ordinary income. And I'll talk about Social Security and how these are taxed in a few minutes here. Mentioned the IRA distributions, those are taxed as ordinary income with two exceptions. Okay, and these are big exceptions. Number one, the Roth exception, in which case they're not taxed at all, as long as we meet certain very minimal rules, which I'll get to in a few minutes. But so if it's a Roth distribution, or if it's a traditional IRA for which you haven't taken a deduction for. And this is for a lot of people that you're putting in 3,000 and then 4,000, and every year it goes up a little bit and you contribute more. And so, maybe over the last 20 years, you put $100,000 in. Well, you have $100,000 of basis in your IRA that, let's say, it was worth $1 million. You know that 10% of it, the 100,000, is not taxable. So that when you take out distributions, 90% is taxable and 10% isn't. But we want to make sure that we understand how IRAs are going to be taxed. Then if we're taking money out of any sort of retirement plan that we have, any of these defined contribution plans where they tell us this is how much you can contribute every single year to your 401k or your SEP or your Simple or 403b or whatever. And then if you're fortunate enough to have a pension plan as well, so this is something where it's saying, we're going to pay you $5,000 per month beginning at age 65 or whatever the terms of it are. We also then have to look at some of our investments. How are these going to be taxed? So when we get interest income, if we make a loan or we get interest income on a savings account, that's going to be taxed as ordinary income. So anything between 10 and 37%. And the same thing with these non-qualified and short-term capital gains. So these guys are also taxed just like interest income at somewhere between 10 and 37%. If we get into the long-term capital gains, and that's where we're holding a stock, some sort of bond, some sort of a security for at least 1 year and 1 day, or a qualified dividend, something from a US based company trading on a US market typically, those are going to be taxed at qualified rates. And they could be anything from 0% on these long term capital gains up to the maximum of 20%. So we don't know exactly what these amounts are going to be, but they're clearly going to be less than the maximum 37% as long as it's a qualified dividend or a long-term capital gain. Now, other things don't stop during retirement. I think this is something that, maybe surprises a lot of people that, hey, dude, we may be, in our late 60s or we may be 75 or something, but yeah, you're collecting Social Security benefits because you've reached the full retirement age. But that doesn't mean that you've stopped working. You may be, still collecting wages. So, I mean, I've put that on here too. Or you may be in business in some way. So you've got a K1 because you've got this LLC that is taxed as a partnership or an S corporation. Or you have maybe a disregarded LLC or a sole proprietorship that's taxed as a Schedule C. You've got some farming or ranching that's going to be taxed as a Schedule F, or all these different schedules that could come into play with real estate, and whether that's going to go on a K1 or you're going to go with the Schedule E. But a whole lot of planning comes in. So just because you may say, you know what, I'm done with the job, or I've been running this business for the last 30 years, I'm going to sell this business, maybe do some consulting on the side, in which case I may end up with, maybe an S corp that I set up and I get a K1, or maybe I don't care about the asset protection or the tax planning and I just do my consulting through a Schedule C. Fine, whatever it is that you're doing here, understand where you may be getting some of this income sources. And then you may also be getting benefits as well. Maybe you have disability or some sort of insurance proceeds. Maybe you get an inheritance during retirement. So somebody, a spouse or a parent or somebody passes away. So look at all the different possibilities of retirement source income and how it's going to be taxed. And then also, when is it going to be taxed? So some of this stuff you can decide to string out or defer, right? You can decide whether you want to sell a stock or not, and whether you want to incur a long-term or a short-term capital gain. That's up to you. Some of the stuff, though, isn't really discretionary. And this is where we can run into some of the problems. So I started here with our RMDs, okay? R for required, M for minimum, D for distribution. So required minimum distributions. This applies to traditional IRAs, okay? Notice that it does not apply to Roths. So forget about Roths, okay? The reason it applies for traditional is because the government wants to start taxing this money. And when you pull it out of a Roth during retirement, it's not going to be taxed. So the government says they don't really care. So they want tax money. So the traditional IRAs and also the regular 401k plan. So the traditional 401k, 403b type plans. This happens now at age 73. So this was a bump up from what used to be for quite a long time. It was always age 70 and a half. And then it was bumped up a few years ago to age 72. Last year, it was bumped up to age 73. So in the year that you turn age 73, you must begin to take minimum distributions. And if you don't, there can be this 50% penalty. So you don't want to mess this up here. Now, fortunately, the mutual fund companies, the TD Ameritrades, or excuse me, I guess it's now Schwab, but all these brokerage companies, they'll all provide RMD calculations for you if you've got IRAs or 401s or 403 counts with them. IRS provides the life expectancy table, so you can go to irs.gov and pull these down as far as the different actuary tables. One of the things that I think people are not aware of is that you can use one of these tools, and this is the last bullet point here that which I'm kind of blurring around here, making a bunch of circles in red here. These QCDs, these qualified charitable distributions, and let's say that you're required to take 30,000 from your IRA as an RMD. You could say, instead of me taking that 30 grand, just take the whole 30,000 and give it to this particular religious organization or this health organization or whatever it happens to be. And you can do that this year up to $105,000. So if you're a multimillionaire and let's say you got to take out, more than $100,000 from your IRA, if you're going to give money to charity anyways, you can give that money directly from the IRA to the charity and not have this income show up on your tax return. Okay, so it's a really nice tax planning vehicle because it keeps your adjusted gross income down, which is ultimately going to keep your taxable income down, and it's going to ultimately keep your tax bracket down. So look at this way of donating to charity. If you're going to do this anyways, why not do it from an IRA or 401k plan to satisfy your RMDs, especially if you're now age at least 73 this year. So here's an example of how this works. And it took somebody today, I put this slide in. So um, today I just put it together, but I said, all right, what happens if somebody had a birthday 73 years ago? So if you did, got this little happy birthday here for you. But here's what our situation is. So as of today, this is what our IRA is worth. Okay, one of these four numbers. I just put this into a calculator and it's actually on the ARP website, aarp.com. And if we just take whatever our balance is and you just say, every year it's going to earn 5%. So keep doing this very conservatively. You're putting it in a money market. We're not doing anything extravagant, but I'm assuming very little growth here. And you've got $100,000 in that. This is the amount that you've got to take out every single year. And it goes up every year for a couple reasons. One, you're getting some growth here in the IRA, but two, as you live longer, the number of years that you quote unquote have left to live, right? At this point here, you're 73 here, you're 83 here, you're 93 here, but it would keep going, you'd be 103. And so you could see that the less number of years you have, the higher the numbers are going to be percentage wise in the actuary tables. And so this is the annual contribution, or excuse me, distribution amounts that you need to take if you have $500,000 today and it happens to be your 73rd birthday. $1 million here. Notice too that it's pretty much 10 times, right? These amounts. So again, keeping with that. And if you happen to be quite wealthy, you can see that you'd be getting over the amounts that we'd be looking at for the qualified charitable distribution. So even if you have $1 million in there this year, you still have to take out only 37,000, but that's $37,000 that's going to be taxed as ordinary income. And unless you donate all that to charity, you're going to pay tax at somewhere between 10 and 37%, plus your state income tax as well. All right. So the other thing I think you need to be looking at here, and this not only applies obviously to those who are retired, because you need to know, well, what are the tax rates going to be like when I'm retired, but really for those who are currently working. And the closer you are to that retirement age and your whatever goal that happens to be. So if you set a goal to accumulate X number of dollars and you can do it next year, I say go for it, right? Go for the retirement and see what you can pull off. And I don't look at retirement necessarily as an age, but as a way for you to achieve whatever the goals are that you have. But let's say that I'm looking at retiring 5, 10, 15 years from now, whatever it happens to be. What do you think the tax rates are going to be when I retire? So if I'm 5 years out and I'm looking, I'm saying, all right, let's say you're paying attention to me tonight, you're listening, and you say, I remember that guy said 10 to 37% were the current rates, And let's say you're making a half million bucks and you're in that high bracket. So you're paying 37%, and you're going to make more money in the future. In 5 years, do you think it's going to be 37%? Or do you think it's going to be more? Or do you think it's going to be less? Now, when I do this live, live meaning like, in a big room or something, and I say how many people think their taxes are going to go down, everybody laughs, right? Because unless your income is going to go way down, and that's possible during retirement, right? If you understand, what your sources of income are going to be and whatever during retirement, and maybe you are making a big income and it's going to be decreased quite a bit. But the tax rates themselves, I mean, how many politicians are you going to see that are going to get in and Congress is going to be able to work through a tax relief bill that's going to cover everyone? It's simply very, very unlikely to happen. And so the obvious choice here is that your tax rates at 10 to 37% currently are likely to remain somewhere in that ballpark or go up. So we have to plan for this possible future tax increase. We also have to be planning for potentially less deductions. So maybe you've paid off your mortgage and you don't have a mortgage interest deduction, or maybe you're donating less to charity. I don't know what it would be, but you may have less deductions as far as itemized deductions go. Maybe you're selling off some investments that were kicking off some nice tax deductions, right? Like real estate or something to pay for retirement. And understand too that during retirement, your personal expenses may not actually be reduced. So you may not be getting a break much on what you're spending. All right, so let's look now at some real specific questions. And the first one is one, right, that drives everybody nuts about taxes, including myself. Are Social Security taxes benefits taxable? Answer, like everything else with taxes, maybe. What the tax lawyer is saying is, I don't know. I really just don't know. Well, it can't be that difficult. Well, it kind of is. It's kind of a mess. First of all, no matter who you are and no matter how much you're getting in benefits, the most that the government's going to tax of the benefits is 85%. And you can avoid delaying taking the benefits to avoid taxation. So while you can begin taking benefits for the old age part of the a component of Social Security. I'm not talking about disability here. You can begin to take benefits at age 62. For most of us, it's age 67. Okay, they put in, used to be age 66, got bumped up. So pretty much for all of us here today, we're looking at age 67 as full retirement. So if we delay taking the benefits for these 5 years, typically then we don't have to worry about some of the tax rules that are going to come into play. But no matter what the case may be, and even if we're looking at, Bill Gates or somebody taking the Social Security benefits whenever it is that he retires with billions of income, assuming that was the case, at least millions, he's going to only be taxed on 85% and avoid taxation on 15% under current laws. What you really need to look at on the Social Security benefits and when you should take them, the timing issue is, do you really need the money? Because the problem with taking the benefits early, not only are you getting reduced benefits, but if you've got earned income, so this is wages or whatever, it could be partnership income or whatever, when it goes over this very small amount, it's 21,320 this year, but when it goes over that small amount, your benefits start getting reduced by $1 for every $2 over this amount that you go. So if you make, say, $61,000, $40,000 there, you divide it by two, and you would lose $20,000 of your Social Security benefits by doing that. So, the question here, again, going back to, do you need the money? If the answer is no, and you're still working, you're going to delay taking the benefits, at least till your full retirement age. Once you reach your full retirement age, so let's say you reach it this year, so you happen to be that birthday guy on the slide, the last couple slides ago. So today's your birthday, you reach retirement age this year. Now, if you're working this year, this $21,000 number goes up to 59,520. And instead of getting reduced a buck for every $2, it gets a buck for every $3. So in your full retirement year, the year you turn age 67, that year, if as long as you don't earn more than this 59,000 amount, you're okay. But once you go over this amount, you'll start losing some of your benefits. Once you get through this year, though, and reach full retirement age, so let's say I'm 74, 75, 80, whatever it is, there's no limit on how much I can earn. So I could make $1 million in a W 2 and I would get my full benefits, no benefit reduction. I'd pay the 85% on the full benefits, but I'm going to get the full benefits here. And here's how it plays out as far as how much is going to be taxed. I've been throwing this 85% number around, but if we look at what your Social Security is that you get during the year, and we take 50% of that, okay, so whatever that number is, because that's how we're starting off all three of these bullet points. So we take the number, let's say we got 20,000 of Social Security, so we take half of that, that's 10 grand, plus 100% of your other income. So this could be interest, dividends, capital gains, anything else that's taxed, pensions, IRA distributions. And if you add all that up and it comes out to less than 25 grand if you're single, and 32 grand if you're married and you file joint, married couples here, none of the Social Security benefits are taxable. So that 85% doesn't apply if you're here. If now these numbers go up and instead you're over this 25 grand amount, but instead you're under 32, so it goes up just that 7,000 and just 10,000 for married couples, then 50% gets taxed. And then when you go above this amount, this 34,000 or 44,000, obviously not terribly difficult to do, then up to 85% gets taxed. So that's just basically how the benefits are going to be taxed during retirement as ordinary income. Okay. Now, contribute to an IRA during retirement. I get this question all the time. Can I do it? The answer is yes, you can if you have earned income. And if you have earned income and your spouse doesn't, your spouse can also contribute with a spousal plan. This can be traditional or Roth. And the earned income, what does that mean? Well, yeah, if you got salaries or wages or whatever, certainly that works. Guaranteed payments from a partnership. So a lot of you that have LLCs out there that are taxed as a partnership may be getting guaranteed payments. You're not getting wages from them. So this is a way for you to basically pay into the Social Security system, also qualify for retirement plan type contributions, and then contribute to the IRA. So you can do that during retirement as well. Or also net profits from a Schedule C will do it too, because those are subject to self-employment tax. I also get asked about health savings accounts. And it's like, hey, can I do that as well during retirement? And the answer is, yeah, you sure can if you have these high deductible health plans. And remember, triple tax benefit here. This is why I love the HSAs, these health savings accounts. What's the triple tax benefit? Number one, you get a tax deduction for the amount that you put in. So let's say you put 5 grand in, you get a tax deduction for that, may save you 1,000 or 2,000 bucks on your taxes. Then you invest that wherever. You can invest it in, Fidelity or Vanguard or whoever you want. You get tax deferral. Okay, so all that money that you make while it's being invested goes to tax deferred account, basically. And then when you pull it out and use it for medical expenses, it's tax free. So the deduction, the deferral, and the non-taxability of it when distributed, 3Ds kind of there on the deduction, deferral, and distribution, give you the tax, triple tax benefit. So definitely look at the HSAs. Really, really nice tax plans. Other things that you need to be looking at for tax-free sources of income. Okay, we love these, right? It's like ways that we can get at money without having to share the profits or the proceeds with the government. And I talked about these Roth distributions. And pretty much as long as you've owned the account for at least 5 years and you're at least age 59 and a half, none of the distributions are going to be taxable. Now, anytime you make contributions to a Roth, you can pull those out tax free at any age, and no matter how long you've owned the account. But as long as we satisfy these, anything we pull out from the Roth, not subject to tax, not subject to these RMDs. So we don't have to worry about taking out distributions. If we want to, we can, but we don't have to worry about it. Roth conversions during retirement, yes, you can do that. So I get questions. Well, I've got this traditional IRA. Can I convert it to a Roth? Yes, you can, but it's a taxable event. So is that a good idea? Again, like a lot of tax questions, maybe. For some people, it is, depending on your tax bracket. Maybe you've got a really down year. You've got a lot of losses. Sure, convert 100,000 of your regular traditional IRA to a Roth. Take the tax hit because you've got other losses to soak it up, and maybe that is a good deal. But if you're going to pay a huge tax penalty in the sense of getting all that tax and ordinary income in a big chunk in 1 year, maybe want to rethink your strategy. I mentioned the home sale proceeds from your personal residence. So the 2 out of 5 year rules that I think Don has at least one, if not multiple webinars on how you can qualify for this on your primary residence. So I'm not going to go into all the rules there, but a really nice way to maybe pocket $250,000 or $500,000 tax free, all legal, as far as a home sale rule goes. You can also do rollovers too. And so you can look at doing this for, money in your 401k, and maybe you want to take it to an IRA. Maybe it's get more investment choices, or you can self-direct it easier or whatever. Just be aware that if you take possession of the 401k money, you've got this 60-day rule that you've got to satisfy and get it to it, meaning the proceeds, get the proceeds to the IRA within 60 days, or you're going to get a very rude tax surprise. So that's why I recommend going custodian to custodian. So whoever the custodian of this 401k plan is, let them do the transfer direct to the IRA custodian. You never see the money, and we don't have to worry about any tax penalties potentially. And also capital gains, maybe, right? Maybe you fall in that 0% bracket that I mentioned before. So what is this? A 0% bracket? Well, first of all, it's this column right here. So who are you? Okay, I don't know, right? That's why I said I don't ever know what the taxable capital gains rate is, because I don't know if it's long-term or short-term or who you are. But let's say that you happen to be a married couple and you're filing a joint return. Up to 94,050 of taxable income. This is not adjusted gross income. This is taxable, meaning after your standard deduction or after your itemized deduction. So if you were married filing joint and your taxable income is less than 94,000, some of your long-term, okay, this is not short-term, it's long-term capital gains could be subject to 0% tax. And then some of them could be subject to 15%. And then if you happen to be making a lot of money, in this case over this 580 grand, then some of it could be subject to this 20% as well. But how does this play out? So single filer here, okay, so not married, making $1,000 a week this year. So she's making 52,000 a year. AGI 52,000. I'm assuming there's no investment income or any other real income here to play with. Doesn't itemize, right? Probably can't afford to buy a house with this amount of income. So now she's looking at this taxable income of 37,400. So she could have long-term capital gains net of up to this 9,625 amount before any taxes owed on the gains. So let's say that a while ago she bought a couple shares of Microsoft, 10 shares or whatever it happens to be, for $1,000, and now it's worth 5 grand. And she's held it for several years. So she's got a $4,000 long-term capital gain. She sells it. As long as there's no other long-term capital gains, she pays no tax on that $4,000 sale. Okay. And this is something I think that a lot of people don't realize, or a lot of married couples don't realize it. Like here, let's say that this married couple, let's say that my single person made 52,000. She gets married to somebody making 48,000. They're making 100K together. Again, they don't have enough money to buy the house, so they're not itemizing. And so now together they had this taxable income of almost $71,000. And so as long as their long-term capital gains are less than 23,250, they pay no tax on it. So if let's say they bought Microsoft for 10 grand, sold it for 30 grand, booked a $20,000 profit, and their income was in these ranges, they pay no tax on that. Zero. So again, how can we access tax-free sources of income? And you may be able to manipulate your income, especially during retirement, where you don't have maybe a W-2 or as big of a W-2 to really limit your choices as far as the tax planning. Hey, other sources, maybe you're getting, again, I've mentioned insurance proceeds before. Most of those are going to be tax free. Same with muni bond interest. Gifts and inheritances are both going to be tax free when you receive them, although there's a really, really big difference as far as what happens with your basis here. So if I give you 100 shares of Microsoft that I paid $50 a share for, your basis is $50 a share. So if you turn around and sell it tomorrow for $200 a share, you're going to pay tax on the $150 difference. Rather than if you inherit those same shares, you get what's called a step up in basis. And then if you sell it, let's say the day after that, you pay nothing in tax. So even though if you receive a gift or an inheritance, you don't pay any tax on that at the federal level, you need to be aware of the differences when you go to sell those investments. Accelerated death benefits from life insurance. So if you're, let's say, you find out you're gonna die in 5 years or something, you can accelerate your death benefits and maybe get tax-free status there as far as the money you're receiving. Other things that you need to look at that may be mixed in retirement, annuity payments. So most of the time here, you're going to be looking at principal coming back tax-free, remainder is taxable. The company that issued the annuity will be issuing you a tax document to be able to show you that, hey, this is the amount, let's say the annuity paid you 10 grand, 2 grand was principal, and 8 grand was taxable as investment income or whatever. It's taxed as ordinary income, not capital gains. Different rules if annuity purchased with pre-tax funds, meaning you didn't pay tax already, then everything that you pull out, including the principal, is taxable. But I think one of the things that people don't understand sometimes, and this applies also to IRAs. Let's say that in your IRA, you bought Microsoft a long time ago, and it just built up and built up and built up, and your IRA sells it. So it's been a long-term capital gain. When you pull it out, it's ordinary income. And the same thing with an annuity, even though there may be long-term capital gains baked into the annuity, when you pull it out as a distribution, it's taxed as ordinary income. And so here's some of the different features. I don't want to get into annuities because they get to be quite complicated. But different ones are qualified versus non-qualified here. Differences typically coming as far as pre-tax funding or after-tax funding. And so there's different limitations as to how you're funding them, whether it's going to be typically through a retirement type account, which is what we're going to see in this column here. And then the non-qualified ones are going to be typically ones that are paid out of pocket, not through a retirement plan. So just understand that there are these couple different types of annuities out there, qualified versus non-qualified. And of course, you can go with huge number of different hybrids and different variations on a theme within each one of these columns. So, get with somebody that you trust on the financial advice side financial planning side to make sure that you understand what it is that you're investing in, understand what the current tax benefits are. In other words, do you get a tax deduction today if you buy $100,000 annuity? Or do you get the tax benefits when you take it out? And when do you have to take it out? And how is it going to be taxed? And there's a lot of different things that you want to find out before you invest in an annuity or invest in anything for that matter, right? Do your due diligence. Other things to look at, I've been talking about IRS taxes at the federal level, but we haven't looked at tax-friendly states. And so, a lot of folks say, oh, I'll go retire in Washington, or I'll retire in Wyoming or something, because they don't have an income tax. Well, that's true, but they have other taxes. And so you may want to see, well, what are those other taxes? And is that going to increase my tax bill? So, yeah, maybe Washington looks really good to you. Maybe Texas looks really good, but maybe the property taxes don't look so good. Or this, it depends on where these states are getting their tax revenue from. So it could be gambling, or it could be oil and gas, or whatever. A lot of states exclude some type of retirement income from taxation. So this varies state to state, very different depending on where you live. Some states also exclude some investment income, whether these be dividends or interest income, or capital gains, or what have you. And a little bit over half of our states do not tax military retirement pay. Still surprised that there's 21 states that do, but notwithstanding that, let's take a look. And again, some of these slides are a little hard to read because I kind of blew them up a little bit, but you can see here that the tax-friendly states are going to be our gray guys. And so our Texas here and Nevada, and the darker the color here, the worse the state is as far as the income tax goes. So I'm not doing too bad here, living in a relatively tax-friendly state of Colorado at a little over 4% here. But you can see some of these states like Oregon and like California. You see New York, Illinois used to be in this category. Some of these states are not tax-friendly. And so if you've got, let's say, a couple $100,000 of income, do you want to give 10% of that to the state of California when you could give nothing to the state of Nevada? And so I think you can see why a lot of people retire going in this direction, right? Because why do you want to give 10% of your income, to the state of California when the state of Florida says we don't want it? Now, again, you're going to be taxed on different things. You have to look at sales, property taxes, different taxes. So, it costs money to run the state government in Florida and Texas and Nevada, just like anywhere else. So they're getting their money from somewhere, but you may like the sources of their revenue a lot better than what comes off of your personal income tax return. So tax-friendly states are certainly something to look at. Also, look at the tax rates on long-term capital gains, because some states exempt those. So, you don't have these capital gains taxes. Again, Wyoming, we like South Dakota. We're even looking down here, right? Our guys in Tennessee and back over here in Nevada. So different states are going to tax the different types of investments in a different way. And I mentioned the military retirement, how most of the states are not taxing it. So our good guys are these gray states here. But come on, California. I mean, bad guys here or partially taxing it. I mean, that's my state right here, too. So some of these states need to get with it. And I get it. I think Colorado taxes it only when your income exceeds a certain amount. But still, let's take a look at that. So it may be something where, if your sources of income are coming from military retirement, and you've got other retirement income that's coming in, and you've got a very nice retirement, whatever, establishing residency right over here in Nevada, could be a major tax break for you. You could be talking about a double-digit tax savings every single year. And so I think you can see why that could be an attractive way to at least think about things. And then here, I know this is very difficult to read, but at least those that are watching this as a replay, can maybe pause the presentation here and kind of read some of these different I guess little blurbs here on the index as far as what it means. But generally, the blue and the purple are better here as far as what states are better from an income tax standpoint with regards to your Social Security benefits. So again, just be aware that there are different tax benefits at the state level and also tax detriments, right, that you may not have at the federal level, that your Social Security or your military pay or some other different type of benefit may be taxed differently for your states versus the IRS. All right. A couple of other things that I want to look at before I end the presentation here tonight is that you also, during retirement and before you move into retirement, need to be looking at your overall estate. Your estate, meaning if you added up everything that you have and put it down on paper, all of your assets and all of your liabilities, what do you really own? And do we have an opportunity here to do some estate planning with some current income tax planning? So this gives us an opportunity with gifts. And this is a maximum of 17,000 last year or 18,000 this year. And I want to clarify that with the next slide. So, because I get people confused all the time because they think that's the most you can give. And the answer is no, this is not the most you can give. It's the most you can give without having to file a gift tax return. You can give way more than 18,000 this year to anybody that you want, related to you or otherwise. Okay, you can give it to anybody, but you may have to file a gift tax return. But when I'm talking about some of the gifting strategies, and again, you want to sort of merge this with estate planning because if you're gifting appreciated assets, which may be a good strategy from a current income tax standpoint, because then you could have somebody else sell those assets and book the capital gain, or maybe if they're in one of those 0% categories, maybe pay nothing at the family level. But again, you want to make sure that you understand that relative to your estate plan and the current step up in basis. But it gives us an opportunity to shift income to people that are in a different income bracket, someone obviously in a lower one. So here's how this works with our annual gift tax exclusion, our annual $18,000 amount. So we've got this $18,000 bucket right over here. Okay, so I can put 18,000 in. And the question is, did I go over that? Well, no, I gave somebody 10 grand. Fine, I don't have to worry about this slide. But let's say I gave them 30,000. So did I go above the annual exclusion? Yes. I file a gift tax. I meaning the person who makes the gift, not the person who gets it, receives, not the person who receives the gift, but the person who makes it. So this $30,000 gift, I file here this gift tax return. I take off my 18,000. I've got 12,000 left over. 12,000 gets subtracted here against my lifetime exemption. And once that's exhausted, then there's gift tax due. So the only question then becomes, well, hey, what's this number here, right? This $12,000, what's that number that gets subtracted from? Well, it's a pretty big number. You're talking about $11 million in some change here. Actually, I think it's more than that. I think I have a slide on that here in a minute here. But anyways, with the gifting, as far as getting that asset out of your estate, and it's something that I think everybody should be considering because a few things. One, we don't typically know the year that we're going to die. And two, very likely, we don't know what the estate tax rules and rates are going to be in that particular year. So gifting strategies can be used for 2024 in the future. And you can do that today. Unlimited amounts for qualified tuition or medical. So if somebody has big medical bills or you want to pay for their 4 years of tuition, you can do that and not worry about this 18 grand a year. But the benefit here is, again, it gets the asset out of your estate as well as it removes the appreciation on that asset from the estate as well. So real big opportunity for some intra-family tax planning. I mentioned before the RMD rules here at the bottom, so we can still do this as well. But I like the fact that in the future here, I think that there's going to be a potential reduction in the estate tax exemption. And so by doing this now, we're sort of meeting the future head on. Because when I said just a few minutes ago was 11 million or whatever, I'm only off by a couple million, right? Here's our number 13.6 million, 27.2, I guess it is now for married couples with some good tax planning and estate planning in there. The problem here is that these numbers go up and then they sunset at the end of 25. And so, what's the estate tax rate going to be? And also, what's the exclusion amount going to be? So, when that guy had to take off 12,000 because he made a $30,000 gift, it would come off of this number. And so, instead of having 13,610,000, you'd subtract 12,000 and you'd have whatever 13,598. So, big deal, right? So, it's not going to generate any taxes, although it would generate a tax return. Also, 12 states that have their own estate taxes. So that's something that we want to be cognizant about as well. So if you're in the gray here, you're in good shape. But if you're one of these states that's colored here, in some ways you have an estate tax. And so if we look at these two guys over here in I guess that's a yellowish color, mustardy color. So the mustardy yellowy color here, you have an estate tax, and our dark bluish color guys have an inheritance tax. So when we're always talking about, you don't have to worry about the fact that, if it's an inheritance, you're not going to pay tax on it. Well, that's true at the federal level, but that may not be true at the state level. So be aware that, there's all these different rules out there. And, we've got to figure all this stuff out. And I think that this is really the hard part, I think, from sort of my perspective, is that the rules are constantly changing. So what we have to do is we have to look at what are the rules today. And if we're currently in retirement, so I'm not working in the sense of I don't have W-2 coming in, still doing plenty, but I just don't have this W-2 that I need to worry about from a tax perspective. You still need to consider what are your sources of income. So consider the source of income from anywhere that you're getting it. So is this from a Roth? Is it from a traditional? Is it from a pension? Is it from a bank account? Is it a mutual fund? Is it a stock sale? Is it rent from a tenant? Is it a capital gain? What is it? And be aware that when we're talking about ordinary income, this can be up to 37% plus, this is a big plus state taxes. So if you're out in California, and of course we like to use this, the California rule, just because it ends up being, you could be ending up being at 13%. Add it together, you can end up giving half of your money to government, right? And so of course we don't want that, but be aware that this could be up to 37% of the feds plus whatever your state happens to be. If you're one of the 40, if you live in one of the 43 states, I guess, that has an income tax. And consider the future. And this is especially important for somebody who's not quite there yet, as far as the retirement goes. So consider that 5 years from now, 2 years from now, 20 years from now, you're going to be retired. What do you think those tax rates are going to be? And how are you going to get the money out? How are you going to get the money to fund your retirement? You need to understand your long-term capital gain strategy. So it can, we can get it into this 0%, or we try to keep it in the 15%. Or if it goes up to 20%, be aware that this Medicare surtax, the Obamacare tax, really puts our long-term capital gains rate at 23.8. So know that where this money is coming from, and be aware that, maybe you've held a stock for 10 months. And if you can hold it now for a couple more months and get over a year and a day, now your tax rate could be 15% instead of maybe 25 or 30 or something higher. understand your gifting and estate tax strategies, and itemized deductions. So maybe you can bunch your deductions to itemize in 24, take the standard in 25, itemize in 26, so that you're bunching your charitable donations or other types of deductions. And realize too that, as I mentioned here in this final bullet point, and this is what I'll conclude on, is that that the gifting and estate taxes are really an issue that we all need to think about. Even if we're not worth this 13.6 million, or we're married or not worth anywhere near 27 million combined. It doesn't matter, because we don't know, that number could drop down to a couple million in the future. And now when you put life insurance and you put a bunch of other stuff in the mix here, a lot of us on this call here today and watching this replay in the future could very well be in the crosshairs of an estate tax. So the gifting and estate taxes certainly have a play in the future, but they can also impact your current income taxes and what you put in your 1040. So be aware, these are all very related. And so, anyways, I'm going to end my presentation, I guess, about 4 minutes later than I wanted to. I wanted to end at half past on the hour, and apologize for going 4 minutes late here, Don. But I think it's just so important, because I've been planning for retirement, and I'm not there yet, but certainly a lot closer than I was just a short little while ago. And but the taxes are so relevant, because think about all the tax money that you can save, and what you can do with that to the kids and the grandkids, and your travel plans and the home renovations and all this stuff that you'd rather do with your money, rather than just giving it to the folks at the state or the federal level. So anyways, those are my thoughts on the whole tax matters, I guess, with respect to retirement. I think we probably have a couple questions here, but I'm going to turn it back over to you, Don, and let you take the stage here.
Well, I absolutely appreciate it. And, I had a brand new granddaughter last Friday. Um, and Scott, my youngest son, Andy, they had a little baby, and I would just as soon benefit grandchildren, frankly, than pay taxes. So I totally agree with you. Okay, let's go through. We've got about less than 20 minutes to answer some questions. Let's hit them first. Jay, your question about buying a house is not necessarily a tax question. Um, but Scott, maybe you have some input. He has some. He's not working a 9 to 5 job anymore. He has Social Security, a pension, so he doesn't have income. W-2 income.
Yeah,
Um,
I think, that's a hard question, because a lot of it so depends on where you live. If you live in a place like Denver here, where the housing market is so out of whack with reality and the prices are so high, it's so much more difficult than if you live in a much more reasonable price place. But I think the first thing to start with is looking at the financing and how much could you qualify for with the amount of income that you're getting, from Social Security and pension and whatever. And then also, what sources of assets do you have that could potentially be secured for a loan? And then once you do that, get the mortgage, buy your house, then of course, then you qualify for the mortgage interest deduction. You get your charitable donation deduction, and you get up to $10,000 of state and local income and property taxes, plus your medical expenses, maybe if you go over a certain amount. So those are all something to consider, I think. But I'd start with seeing if you can qualify for the mortgage first, because that's where the bulk of your tax deduction is going to come from.
I read something out of the Wall Street Journal. I saw a graph last week. It said 16% of houses in the U.S. were affordable last year in 2023. It's a tough market, Jay. I don't know. Okay, can a person self-employed open a 401 account? You really need to have a company, don't you, to open a
Yeah.
401 account?
Yeah, I mean, you can open it up in a sole proprietorship. I mean, you can do it that way, but it says here to what's a requirement for any number of employees or whatever. No, you can have a single member LLC, taxed as an S corp, let's say, and you set up a solo 401k plan. You can certainly do something like that. And not only can you do it, you probably should be doing it. Look at how you're structured, and then the one constant with all of these plans is that there's no discrimination permitted. Okay, so if you have employees, you can't say, let's say that I've got a business here and Don's my employee. I can't say, well, I'm going to feed my account here and contribute 25 grand, but Don's never going to know about it. I'm just going to forget about him. No, as long as Don qualifies for the plan, and there's different rules, did he work here 3 of the 5 years and different amounts, but whatever. If I've got employees, I've got to include Don in the plan as well if he qualifies. So make sure you don't discriminate in any of the retirement plans if you're the employer.
But SEPs and 401ks are certainly available. You have to have a business. Okay,
Yes.
Brian is asking, do monetary gifts to eligible dependents count as a charitable contribution? Wow, I wish that were true. Wouldn't that be
Boy,
cool?
boy, boy, I'd be zeroing out my taxes every year and then some probably. The IRS
Um,
would be owing me money every year. I wish that was the case. No, when you look at charitable donations, and this is something that's not always intuitive, and I kind of chuckle at the question, but it's a really good question because sometimes people will set up a GoFundMe. So let's say that I get into a car accident and I don't have any money, and I say, hey, I need $5,000, and people start contributing. You think that's a charitable donation? It's like, no, it's not. It's a gift. It's like you need to contribute something to a qualified charity. So if I contributed 5 grand to a church, and in the church being a qualified charity, and then the church then helped me out with my car repair, I could get the deduction for that. But if you just made a $5,000, gift, I guess, to Scott's GoFundMe to fix his car, not going to work. And the same thing with your kids. So it's got to be a qualified charity. And you go to the IRS website and search qualified charity, they have a database there. So you would know right away that if there's Scott's Charity here, you could search that and see, is Scott's Charity a legitimate 501c3 or C6 or whatever the code provision is. And if so, it would pop up there, and then you could make a donation to Scott's Charity and qualify for a tax deduction.
Qualified by the IRS, not by
Yes,
themselves. Yeah,
correct. Yes, the IRS qualified them
yeah.
through a pretty rigorous program, actually.
Are the RMDs for solo 401k traditional money, solo 401k Roth money? Both of them are for
Yes,
RMD.
and no. So there are MDs. Yes, there are for a traditional 401k, solo or otherwise. When you put the Roth component in, no matter what the account type is, when you see Roth, think no RMDs. Really, really nice. Actually, one of the few clean sort of tax rules that we have.
Hey, can I contribute to an HSA on a medical advantage plan? Well, it has to be a high deductible plan. Is a
Right.
Medicare Advantage plan a high deductible?
No, no, you would not be able to on a Medicare plan because yeah, it's not a high deductible plan.
How is the amount of long-term gain that gets 0% calculated? I think we covered that in your slides, didn't we?
Yeah, I mean, I think he's asking how does it get calculated, and I think really what you're looking at there is you figure out your taxable income without respect to long-term capital gains, and then once you have that number, then you look at the long-term capital gains and you figure out how much of that gets taxed at 0%, how much of that then, when you go over the whatever the threshold is, then the rest of that gets taxed at 15%. So it can be a blended rate.
Okay. Pete is asking about annuity payments. Are they part of your RMD? And I guess it would depend on whether it's owned by what the annuity, whether it's owned by the IRA or not. If it's
Right.
in your name, there's no RMDs. But if it's owned by the IRA, then there would be. Is that
Correct.
correct? Yep.
Perfect answer. Perfect answer. Good question, though.
Oh, yes. I still have 401k with my former employee. Is it advisable to leave them when I take RMDs, or should I move to an IRA before I take the R? That's an
Uh,
investment question, isn't it?
Yeah, that's really an investment question. I mean, most people would rather move their money out of the 401k, get it into an IRA, and they have more control over it and get it out of the former employer. But either way, just remember the 60-day rule on that slide, that if you take possession of that money, you've got to get it into the IRA within 60 days, or you're not going to like the results.
Okay. Before we go to Brian's questions, do you like having annuities inside of a 401k in an IRA? I
Well,
traditionally
they're
don't.
tax, yeah, they're tax sheltered otherwise. So it's like, it's almost like you're putting a tax sheltered investment inside of a tax sheltered investment, And so I think for a lot of people, it makes a lot more sense to put other assets in their IRA than an annuity.
Yeah, I don't like that. I'm not an expert on this, but I don't see the advantages. I see a lot of insurance salesmen selling annuities to IRAs, and I think they're overselling it. Do you want to look at
Yes, I
that
agree with you.
as or did we just answer it by
Well, yeah, I think you're right. I think the one thing to look at with annuities is who are they good for, and like who needs them, and what does the agent get out of it? Because a lot of times they're big fat commissions to the agent up front, and so the agents are incentivized to push annuities, even though it may not be in the best interest of their clients. So I think just make sure that whoever's giving you financial advice, make sure they're looking out for your best interests and not theirs.
totally agree? Peter's saying I'm 73 this year and retired, but I have W-2 income. Can I open an IRA? As long as you have earned income, you can open the
Hmm.
IRA, regardless of
Right,
your. Can I open IRAs to shelter income? How do the RMDs work then?
right. And I think I had the one slide up there on the RMD. So the year you turn 73, that's fine. You can look at the amount of income you're making relative to whether any of your benefits will be reduced or otherwise taxed. But no, you should be, I mean, you're good to go. You've got earned income, right? So you definitely should be making IRA contributions. And if your employer permits it, make as big of a 401k or SEP or whatever, plan that the employer offers, make as big of a contribution as you possibly can afford or can do.
Okay, great. What constitutes a qualified charity? I think we answered that,
Yeah.
didn't we?
Yep.
The IRS has to recognize it and check their database.
Hmm.
You also get the same amount of exemption, 250, 500, if it's an investment property. No, that would have to be your personal residence. Is that what we're
Right.
talking about? Yeah. Would the
Right.
cash value from the IUL considered to be taxable income?
So we're looking at cash value from a universal life policy.
Yes.
So
Correct.
not going to typically be taxable income unless you deducted the premium payments.
Okay. How are Roth investment earnings in a revocable living trust taxed? Well, the revocable living trust is a disregarded entity. So, and the Roth is when you're taking money out, it's tax free. So the fact that the Roth dumps into the revocable living trust has no tax event of
Correct.
no tax consequence. Am I right there?
You're absolutely correct, Professor. Keep
Well,
going.
I got
No,
one
you're
right.
doing
No,
great.
no, no, that's good.
No, no, no.
If
You
I'm
got
on,
you got three in a row going. You're on a roll. Let's go.
well, okay, I'm on Medicare. Can I still have an HSA? The qualification is you have to have a high deductible health plan, of which Medicare is not. How's
Right.
that? Is that four?
Mm-hmm.
Woo! Okay,
It is.
I'll shut up and let you. Is inherited money not taxed as income if less than 12 million?
Uh, I'm not sure where the 12 million doesn't come in. Where is that? Oh, I'm sorry. I see the question. I was inherited money not. Well, inherited money is never taxed. Okay, for federal purposes. Now, that's slide up there that showed there's a few weird states that will tax it. But let's say that, my relative is Bill Gates and he leaves me, billions and billions of dollars, way over 12 million he leaves me. None of that is taxed to me if I live in a tax-friendly state that doesn't tax inheritances. So that 12 million is for the person who dies, and that is estate taxes. Okay, so not the person who receives the money.
Yeah, Scott, go back to that slide. It's 4 or 5 slides back. It shows Nebraska and I don't know, Iowa or I don't know, several states that have an inheritance tax. Right there. So if you're in one of those blue states right there and you receive an inheritance, there will be a state tax for it. And there's limits, and you can see
Right.
that. Or you can go to Tax Foundation where this graph came from and look this up. But there's also a really good article in Kiplinger, October of last year, that goes through and describes all these states in specific detail and how the taxes are calculated. But yeah, unless you're there, there's no money for inheritance.
Don, I think that's a really good point what you just made with that Kiplinger thing, because I read that edition as well. It's like the whole magazine. It took a lot of different angles, but I think one thing I would be looking at here is, let's say I'm in Colorado right now, and let's say I'm considering retiring in some other state, to go to that article, or at least go to Google and say, what are the tax advantages and disadvantages of retiring in Arizona? Let's say that's where I wanted to retire. And I can look and see, do they have an income tax? Do they have an inheritance? Do they tax interest? Do they tax dividends? And then I can look at my tax return and see, it's like, oh my gosh, well, most of my income is coming from capital gains, and that would be a horrible state to retire in. Like I'd lose another 10% of my money or something. Or it'd be a great state to retire in. They don't tax that at all. So I think putting together this whole plan, especially if you're, getting into that sweet spot of, yeah, I'm kind of thinking about retiring sometime in the next decade or so, maybe sooner. You might want to start your search pretty soon and see if there's some planning you can do now, to sort of alleviate some of these problems, before they pop up.
But not every life question is a tax question. And if all my grandkids happen to live in California, I just may bite the bullet and whatever. Okay, so
Sure,
we've got
absolutely. But it should be a consideration, I think. Just
correct,
understand
correct.
everything, right? And not to make the tax as well. I'm only going to live in one of the 7 states that doesn't have an income tax. Well, all right, you're excluding quite a bit of the country then, right? And there's a lot of other things that come into play. But if you're thinking about moving between, Florida and Georgia, let's say, well, maybe you're better off to go to Florida because they don't have an income tax. I don't know, I mean, you can maybe use that to help you flip the coin. Somebody was asking, there's a question down here, the slide about how Social Security is taxed. So I was trying to flip through it because I don't really remember where that was. Um, but
Thank you
anyways,
for
there it
picking a
was.
little edge. And
Okay,
and
so
and
that's a really ugly slide, obviously, with me scratching it out with all these X's and stuff. But I'll just leave that up there because I think that at least, answers the question, and we don't have to go through that again.
great.
Okay,
Okay.
what's next?
What's the best retirement plan for a single member LLC, S corporation election? Should I use a 401k or a SEP? Um, and Jen, my feeling is, what is it you want to invest in? If I'm going to swing a hammer and I'm going to flip houses, I would want something where I would want a 401k, because the the self-dealing rules are a little different in a 401k than a SEP. What are you going to do if I'm going to have somebody else run my rental properties? A SEP might have lower fees than a 401k. Scott, what are your thoughts on, should I be a SEP or a 401k?
I like the 401ks. I mean, here we're saying we have a single member LLC, taxes an S corp. So my first thought is, oh, that's perfect. Do a solo 401k and knock it out. But then I see the rest of the question is the LLC has three employees plus me as the owner, right? So now the solo 401k is out, but we could certainly go just a traditional 401k, or we can go a Roth 401k. We can go either way. Just realize though that whatever you do for yourself here, you've got to include the other three employees if they qualify. And just look up the rules on employee qualification for an employer sponsored 401k plan, and they'll show the years of service, the amount of income. There's just a few rules, and most employees will qualify.
Okay. Scott, we are out of time. Let's take time for two more questions, and then students, there's going to be an open Q&A section in the next 3-day summit. It's coming up June 17th, 18th, 19th. We encourage you to go to Protect Wealth and register for that class. We're going to spend almost a third of the class on taxes and a huge section just on open Q&A. So Scott, if you get time, let's do two more questions. What income level should single retired person consider investing in municipal bonds?
Oh, that's a really tough question there because you're getting into where is the other income being earned as far as the income levels go. But I think, when you look at the municipal bonds, you could have potential high taxes, um, in the sense of you could have alternative minimum taxes. But I think anytime you're in a tax bracket in the 30% or higher, I think that's where the municipal bonds start making a huge amount of sense. But normally the investment advisor will run a calculation for you. And what they'll do is they'll take the return on the municipal bond and they'll divide it by your tax bracket. And they'll look at that return and then they'll compare that to what you could get on a taxable bond and see which is higher. So, maybe you could get 7% on a taxable bond and 5% on a municipal bond, given your tax bracket, which is a better bond to have. So these are more investment questions, but I think really appropriate because you have to start looking at the differences between how these investments are taxed, or maybe in the municipal bond situation, and no AMT, maybe not taxed at all.
Okay. And we've got three questions that are really all the same. Can I contribute to an IRA, 401k pension when you leave a job? And the qualification is you have to have earned income. It doesn't have to be a W-2, it could be a 1099. It just has to be earned. Social Security is not earned. Royalties are not earned. Distributions um, are not earned. Interest income is not earned. You have to have earned income to contribute to an IRA. Scott,
Right.
thoughts on this?
Exactly that. I think the question I would always ask people is the income that you're talking about subject to employment taxes or self-employment taxes? And if the answer to that is yes, then you can contribute to an IRA or 401 or whatever the plan happens to be. But if you have no income during the year that's subject to Social Security or self-employment taxes, then you can't contribute to an IRA or 401k unless it happens to be a spousal plan. So, pretty straightforward there. You need to have that, but really good question. That's why I see some people, they'll go out in retirement, make $6,000 and then put a $6,000 contribution to an IRA. You can do that, but you got to have earned income to do it to begin with.
Scott, thank you so much for your time. Students, I'm sorry we haven't had a time to get to all of them. Scott has other appointments tonight, and I promised him I wouldn't go later than I did, and we're 3 minutes over. So, Scott, I apologize for that. Thank you so much for your time. Students, come back to the summit. We'll see if we can get to your questions there. Scott, any final remarks or final thoughts?
No, we're all good here, Don. Thank you, everybody, for spending a part of your evening with both of us tonight. Or if you're listening to this on a replay, certainly thank you for your time, and hopefully you got a little bit out of this, a little education, to get you at least thinking in the right direction as far as retirement and taxes go. So thank you, everybody.
Awesome information. Thank you, Scott. Everyone, have a great evening. Good night.